Yesterday, I published a Twitter thread explaining the risks for macro volatility to begin to rise again and why that is directly connected with the US bond market. And I want to walk through the tweet a little bit because I have gotten a lot of questions from people, and I know some of the ideas can be a little bit more complex, or you have to understand some of financial markets to understand the implications of them. So I'm just going to walk through the thread and explain some of the ideas just from a very simple perspective and, ask those questions. What is the, tangible implication of XYZ of these ideas? So in the first section, traders in the US bond market are drastically underestimating what is about to take place in macro volatility. The next move in interest rates will set the stage for macro flows over the next 2 years, and no one in the media is talking about it. So the first idea that I lay out here is about how interest rates are the most important part of macro because it's about the price of money. This is key because when we think about all of the different financial assets and then also goods and services that we buy, we typically think in nominal terms. In other words, we think, okay, how is, this thing priced? How many dollars is it in? How many, things can I buy with XYZ? How many cars, houses, whatever it might be? For some people, it's boats, right? How many yachts can I buy? The difficult thing is that you have both supply and demand pressures around goods and services and assets, as well as changes in the quantity of money and the price of money in the system. So we always need to ask is, the changes that we're seeing in goods or services or assets, is that because of a supply and demand issue, or is it because we're seeing a devaluation or more money in the system? And that's a really important starting point because when you see the S&P go up, you have to remember that it's a long short pair trade. In other words, you're long the S&P and you're short dollars. Every single thing that you do in life, you're long something and short something else. Even Bitcoin, you're long Bitcoin and short dollars. There are moments in time where you want to be long dollars and short Bitcoin. And you have to be able to understand the forces that drive both. That's why, like, when we look at different risk assets or currencies or something like that, like if I'm looking at the US dollar, I'm not just looking at the DXY. I'm not just looking at the dollar against the euro. I'm looking at the dollar against every major currency in the world to say, okay, is this a dollar move where the dollar is changing in value, or is this one of the other currency pairs moving? And that's how we really triangulate and say, okay, what is the actual driver behind this? And interest rates are changing the price of money, which means they are the asymmetrical linchpin on which everything turns. And so over the last year, we have seen 30-year interest rates. They have not moved down as much as the Fed has cut rates. And you'll notice that a lot of people, especially at FOMC meetings, especially on the major news platforms, they are talking about interest rates and inflation as if the entire inflationary cycle is behind us. And you'll even notice that the Fed themselves, they are being a bit complacent in how much inflation risk there actually is in the system. Just think about it like this. If the 30-year interest rate continues to just move up, it's clear that inflation and growth in the underlying economy is way more resilient than people recognize. That's the idea. The Fed is controlling the short end of the curve and expectations around the short end. But the market is really, on the long end, it is the one that is moving how the long end functions. The Fed always influences the long end. They're a direct input into the long end. But when you have bear steepening in the curve, which means long end rates are moving up even as short end rates aren't, or they're flat, that's an indication that there is growth in the economy. You had a lot of people think that a inverted or then an uninverted yield curve means recession or the absence thereof, or some idea around that. In reality, what we need to do is say, how is the underlying growth and inflation situation developing? And then how is that connected to the regimes in the yield curve? And if you want to see those regimes in the yield curve, which is bull bear steepening, bull bear flattening, steepener twist, steepener flattening, and understand those are all laid out on the Substack in the tear sheets every single day. And you can see those there. When we think about growth in the US economy, this is one of the things that I laid out, is that people weren't really positioned for the amount of growth that took place. All we have seen thus far in equities is that, you had this move in the beginning of the year where equities moved down, and now they're basically back where they were at the beginning of the year. And, growth hasn't really changed that much. You had GDP turn negative, but that was mainly because of the import-export function, not because the labor market was falling apart. As that is taking place, you're having credit, and then I laid out the entire credit cycle thread here to show that banks are not slowing down in the amount of issuance that they're doing, right? When banks are giving out loans to corporations, banks, broadly speaking, have one of the best views of the underlying economy of anyone, because they're the ones that see all the financial transactions. They're the ones that actually clear the financial transactions. When a bank is giving out credit and debt to corporations, but then coming out on the news media and saying a recession is imminent, you know that there's a problem there, and that they're saying one thing but doing another thing. And that's typical Wall Street. Those are typical banks. That's their job, right? They're trying to get liquidity to be able to get their fill, to be able to issue debt at wider spreads, to be able to make their spread and their fees. And so I've laid out all of this in this primer and this playbook right here. If you go here, there's an entire playbook for how to think about this type of cycle and this type of move, and it's laid out all right there on the Substack. You can find the link in there. So I also laid out the interest rate report explaining that there are real risks mounting for bonds here, where TLT could move down as credit issuance increases in the system. In other words, when you have the banks putting more money into the system, that means there's an oversupply of money. Well, think about what long duration bonds are, what TLT is. TLT is a quote unquote, or let's talk about not the ETF itself, but let's say long duration bonds. Let's say long duration bonds are a representation of a claim on risk-free money in the future. So it doesn't really have a credit component. What does it have? It has a duration component, which means it's all about the time value of money between now and the next 30 years, or now and whenever that gets priced. So when you have more money get pumped into the system, that means that money in the future is now less valuable because you're devaluing it as more and more money gets pumped into the system. Now, that is not the dollar devaluation or dollar going to zero narrative or anything like that. This is just like regular plumbing and credit issuance in the system. This is all regular stuff that's been taking place since the beginning of time. That's all that is. When we talk about the US dollar as a reserve currency status, that's a separate thing. It is connected because it does allow facilitation of more liquidity in the system. But when we have credit issuance increase and growth accelerate in the economy, that's what pushes bonds down. And so that is important to understand. On the Substack, if you go to the Substack, on the main page, there's an entire educational primer on interest rates. And it provides all the resources that you would want to know to think about interest rates. And so what is taking place in markets right now? Traders are betting on lower volatility. You'll notice here, this is the MOVE index moving down in blue as 30-year interest rates move up. The MOVE index is basically representing what implied volatility is for the bond market. In other words, how are traders pricing the standard deviation and variance over the next, let's just say 30 to 60 days? It's saying, okay, do we believe there are going to be large moves or small moves in the bond market in either direction over the next, let's say, 30 to 60 days. And what the market is positioned for is smaller moves. That's why the move index is moving down. Now, that means if you begin to have larger moves, traders are not positioned for it, which can cause larger moves to take place because people aren't positioned for it. This is why so much in markets comes down to positioning, because if everyone is positioned for a certain event, then that event is actually unlikely to happen. The reason why you get large moves in markets is because positioning is offsides. And so the key, especially in macro, is connecting those macro flows with the positioning metrics that we see. And the idea to take away from this chart is that positioning is a bit complacent right now, and they're not expecting some massive move up in 30-year interest rates. And this is taking place at the same time you have crude moving up. And now we're having another day of positive crude. And so that's really important, because if you have crude rally, what is that doing? That's an indication that you're having prices rise in the system. And that is fundamentally inflationary. Now, do I think we're going to move back into a 1970s or another inflationary cycle like 2022? No. But you have to recognize the risks. We have to map how those are changing, because you have to realize a 50 basis point move in inflation, especially core inflation, that can cause a really large move in interest rates. And again, these are pricing money in the entire system. So that means a small move in interest rates, I'm just going to throw out some broad numbers. There's going to be some convexity bro in here that's not going to like it, but whatever. So if you have, let's say, interest rates move let's say 50 basis points or 1%, that can cause assets or goods and services in the economy, they're not going to move 1% as well. They're going to move 7, 8, 9, 10, maybe 15%. It's a nonlinear relationship. A small move in interest rates can cause a large move in assets and in the economy. And what we are seeing right now is not just the media industry not even focusing on this at all, but they're just following what the Fed is doing, where you have all the Fed speeches coming out and saying, well, we have time to see how national policies impact the data. That's not really the case. The long end is sending a signal to the Fed that they're refusing to listen to. And in this environment, stocks and Bitcoins are going to continue to push higher until interest rates get too high and begin to break things in the system. When this happens, macro volatility will blow out. Let me explain how this works. The changes that we see in interest rates have an impact on risk assets, but only in a specific way. What we do for risk assets is we build an attribution analysis model that says how much is the changes in interest rates or the changes in risk assets from interest rates and how much is from underlying growth. If you've ever run a basic DCF model that is just valuing some type of real estate, I think that's a helpful kind of starting place. It's a little bit more complex when we take it to financial markets, but when you have a change in the discounted cash flows, you have two inputs into that asset. One is the cash flows. So are those changing? That connects to the net asset value or how much the property is worth. And then you also have the discount rate to discount those cash flows. So interest rates, they can drag on equities if they are overvalued. That's kind of there's some qualifications for that, but that's a big baseline metric. The more that assets move up in their valuation, the higher sensitivity they have to changes in interest rates. So you'll notice that in 2021, when equities were at their high, they were really overvalued and a bit complacent in terms of valuations. And that's why the hiking cycle began to have an impact on equities because they were overvalued. And you'll notice that once they went back to being undervalued in 2022 at the lows, interest rates began having a less of an impact because they were less overvalued. And so right now, we still have upside. We are not having a ton of complacency yet. When macro volatility blows out, when that move index moves up, when cross-asset volatility begins to rise in crude, in FX, and you have the stock bond correlation flip from negative to positive, that's when you want to sidestep and be able to be out of equities and be out of risk assets. We are not there yet. And that's important to understand that, in my view, we have a bullish equity view, bullish Bitcoin view, and bearish bond view right now. And the entire point, like I've laid out here, the entire point is not to have FUD or freak out and go to cash. The entire point is to understand the distribution of opportunities for equities, bonds, metals, crude, and things like that. That's why I always lay out on the Substack. You want to think like a risk taker and a practitioner, which means you are constantly redundancy planning around all the different possible outcomes that can take place. And you're consistently using that framework to make decisions as opposed to having some perma-bull or perma-bear view. Because that might be a nice view overall, but that's not a view and a framework that makes you money. So this is the video that I really like. It's with the former CEO of Goldman Sachs, and he breaks down how exactly do you think about this redundancy planning framework, and how can you be exceptional at extracting the returns from just being prepared. I would say that's the baseline for thinking about things. So with that, everything is laid out on the Substack. If you go to capitalflowsresearch.com, in the main page, you can go there. All the research is laid out on the Substack. I'm going to try to keep doing these videos that break down things from a educational level so that people can understand the why behind the moves that we are seeing. With that, I will see you guys soon.